What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
Welcome back to Real Vision. I'm Ash Bennington. Today, I'm joined by Dr. Sebastian Purcell, CEO and CIO of 1.2 Capital. Sebastian is also our latest host for the Crypto Academy course, The Art of the Bubble. You can find all the episodes in the Academy at realvision.com/Crypto Academy. That's realvision.com/Crypto Academy. With that said, Sebastian, welcome back. Always a pleasure to be with you.
Yeah, glad to be back, Ash. It's been a little bit since we've had a chat, so I'm looking forward to it.
Yeah, it has been a minute. Listen, we were talking a little bit before the show got started here, a little bit about your background and how it informs how you think about markets, both macro and digital. Let's talk a little bit about that. Let's start there. Talk a little bit about your background and perhaps most importantly, how it influences how you see the world today.
Yeah. So as you know, I made a transition from professor into fund manager, and there was a route there. It involved a student. I had been writing and algorithmic trading for quite some time. Around 2015, I was teaching a course on logic. I'm a logic professor. It's a 2-semester sequence that we had. And one of my students came up after class one day and asked me if I'd heard anything about Bitcoin. And I said, well, yes, I had. The student, we'll just call him Will. He wanted to ask me about it. And he said, great. Well, I won or earned $500 attending bar this last week. And I was thinking about investing in Bitcoin or this other thing where they would guarantee me a 15% return. And I told Will, well, anyone who guarantees you anything in investing is trying to rip you off. And he said, right. And then he just left the room. And I thought he was going to do neither thing, but instead he bought a bunch of Bitcoin. We cut to the next semester. We compare notes. I went to graduate school, learned a bunch of advanced math. Will hodled Bitcoin and beat my returns. I will say that I still did well, but Bitcoin is an asset class that is difficult to beat in traditional markets, especially if it's been on a bull run. So I was at first dismissive and then later realized that I could take my algorithms and just trade cryptocurrencies and make more money, which is roughly how I ended up finding a following of people online. I began to write about that. After the end of the last crypto bull market, 2021, it made sense to go ahead and start a fund. So I had made enough money and we had enough other interested parties that we launched a fund. And that is the short of how I became a crypto fund manager. But my graduate studies in general tend to inform why I was looking at a space like cryptocurrencies and what I was doing before then. Because I had a sort of general thesis about macro global markets. And that ended up over time pushing me in a specific direction of investing. So I hope that that's sort of what we can talk about here.
You want to unfuck your shit? This
is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there. And let's help you unfuck your future.
So it's interesting. So you're teaching and studying analytic philosophy, which I believe where you got your PhD. So you sort of bring this quantitative toolkit to the macro space, to the crypto space, to the digital asset space, to your thesis about Bitcoin. I mean, that's really interesting. It's a different perspective. A lot of folks came to Bitcoin, as you know, of course, via the computer science route.
Right.
Talk a little bit about how that informed your initial view and how it continues to inform your view as a fund manager today.
Yeah. So, I mean, there is clearly a lot of overlap between sort of logical study and computer science. But my thesis itself focused on kind of a weird, arcane question. I was looking at ecosystems, complex systems like the Florida Everglades. If you have something like that, the question I wanted to answer was, is that a single thing or is it a composite of things? When you have an Everglades system, is it reducible to something like just aggregates, or are there somehow emergent properties that make it its own sort of thing? And in my dissertation, I argued that, in fact, it was its own sort of thing because you otherwise couldn't account for certain phenomena. In a nutshell, that's the sort of thing that you write as a graduate student to finish up your PhD. But the investing implications of that are rather immediate. It turns out, and it's surprising, but you can model a complex system, or at least the viability of a complex system, with just two key variables that'll break down into others. But it's what they call ascendency, which is roughly the complexity of the system that you're looking at times the throughput of the system. So if we go back to the Florida Everglades, for example, complexity is sort of the ways in which energy can transfer through the system in a meaningful way. Crocodiles eating, turtles or fish or whatever else. That would be energy transfers through the system. That's the complexity side. The throughput is just how large it is. You could have a petri dish that's really well organized, but it's unlikely to survive. I can just throw it in the trash, right? Because it's not very large. So complexity times throughput equals ascendancy, more or less. You can apply that to the global nation state by just saying productivity levels times population base, or relevant population base, equals GDP and GDP growth, probability of GDP growth. That is the sort of analysis that simplifies where you might want to take bets globally. And that moves us, we're talking like the 10-year time scale. I tend to look at the sort of long-term 10-year plus and then the immediate. I'm not really great at looking at the intermediate stuff. In my experience, that's a lot messier. So this approach basically enabled me to look at complex systems globally and find out more or less where you'd want to place your bets. The key menace going forward, we're talking 2035 forward, is likely population decline. And the promise there is AI may be able to offset that. Again, we have two variables, productivity and population demographics. If population demographics decline a lot, maybe AI can help us with productivity over that period of time. Maybe.
Let's try and find a way to jump into that so that people can follow this one, because it's really interesting. You start out with kind of the theoretical underpinnings. You talk about complexity, you talk about emergent properties. I think about this in a very sort of maybe simplistic way, probably too simplistic, that what emergent properties are is you have a system that's made up of various constituents. And yet when you put them all together in a certain way, you get properties that emerge that aren't inherent in any of the underlying components of the system, but somehow when they all come together, they interact in a way that creates a new system that has properties that look nothing like the components that underlie it.
Right. And that allows you to simplify your analysis at global level, right? That's what I'm saying. They're just really kind of two variables that you can look at. And anyone can effectively go around and track demographics, and that will suggest roughly which areas of the world are likely to grow and which ones are likely to struggle going forward. And then you can start making bets about which sectors might fix these problems, and then you get interesting proposals about where to invest. That's the chain of analysis that slowly got me into digital assets. But not only digital assets, but especially digital assets. So hopefully, if that's clear, and I do have some slides that could kind of show people what this is like. But again, if we're looking at just two key variables, population base and productivity levels, and we assume for the moment the productivity is going to roughly do what it's been doing, our question is, can that somehow offset population-based declines? And more or less, the answer is, at least right now, not for a lot of places. There are three ways in which a population could develop going forward. you could have.
Let me jump in here because I want to break out kind of what's new, what's already understood from what you're adding to it, because this is really what's interesting. So the thesis that you're starting with here is that if you take those two variables, population growth and productivity, and you put them together, you kind of get a nice, relatively orderly, predictable output from that. In other words, if you know that productivity is going to increase at something like 1 or 2% per year, you can plug in population growth and you can get the output from that. That would be the way that a traditional economist might begin to simplify a system so that they can take a look at it and get an overview of what's going to happen at an order of magnitude level estimate. And so what's interesting here is what you're adding to that is looking at that system and say, okay, let's see if we can find what the emergent properties are, and let's add in these new variables that have so far been exogenous. And to your point, AI being obviously one of the key ones.
Yeah, AI being a key kind of stumbling block too, because it's really difficult to model. So for the moment, let's just put AI off to the side for a second. We'll bring it back and just look at the demographics to see what the problem that we're facing right now. If you look at that, you'll find that there are kind of three shapes that populations have. People might be familiar with this. They can be a triangle with a very large base of young people and a very small base of elderly people at the top. They could be sort of a tube, right, with sort of equal proportions of young people and older people. And they can be an inverted triangle or a V shape with very small numbers of young people and plenty of older people.
For people who may be seeing this for the first time, let's walk through those slides so they can get a sense of what you're talking about.
So let's look at China, because that one will show us most of or the problem that we're facing. Right there, what we're looking at is, and this is just freely available data on the internet. You can Google search it quickly. What you're looking at there is between the blue and the red halves are, blue half is men, red half is women. And I've drawn some overlay lines that show you after a certain point, we're getting an inverted V. China did have the regular sort of triangle. So
let's just explain this to people who may not be familiar with this, right? So the top of this distribution is as you rise on the y-axis, the population gets older. As you get lower down, the population gets younger. So what you're seeing there is that sort of natural triangular peak. What you're seeing is people as you get older, there are fewer and fewer very old people in a population. That's the top. That probably looks generally similar. But talk about the rest of that shape where you've got those trend lines drawn, because this is really interesting.
Yeah. So from, I don't know what that is, about the age 60 down, where we tend to get a trend that gets slimmer and slimmer, meaning that each successive generation has fewer people in it. And this is, of course, the source of a lot of consternation about how the young will pay for the old for systems like Social Security, et cetera, in the United States. But at our point of view, we simply want to note that the shape of this is sort of V-shaped. Demographers have looked at this and they've found that when countries move into that V-shaped pattern, they don't tend to come back. And the reason for that is you can't just stimulate lots of new children into existence in a quick fashion. It takes 18 years to get a productive worker, 22 to get more of a high-skilled worker. You can't turn this around quickly. So populations that tend to go V-shaped, historically, none of them have ever come back from that pattern. And that suggests that over the next 10 years with China, they're going to face some significant headwinds in their demographics. Some demographers think that the collapse will happen as soon as 8 years out. So I don't want to put specifics on this. It just looks like they're facing long-term headwinds, which means they're really going to need a lot of productivity to offset those declines.
Probably took about 30 years before I became a productive individual. But when you look at that chart, and by the way, I want to separate out here this component of the thesis, the demographic challenges that exist in China right now. This is the broad consensus view that there is this challenge that China is not replacing enough young workers to take care of the older workers. You see that right at probably about the 60-year line, where you see that, as you say, this V pattern, this idea that there's simply just not enough workers to pay the benefits on the folks who are at the top of that pyramid structure.
Right. Yep. And that also means that they're not going to be able to grow, right? Because as soon as people move into that 60 age range, they tend to be less productive, right? So 10 years from that chart, they're 70, right? They're no longer working or producing at the same level. And that causes concerns about productivity growth. If you were just index investing in China, you would be concerned that index investing is largely tied, at least over a longer cycle, to GDP growth. You would be concerned that it would not grow as much because of the demographic collapse. You're going to need something else, like I said, to counterbalance the productivity side, given the decline on population. There's a similar thing that happens in Germany. If we can look at that slide, people think that it's just related to something like China or whatever else. It is not. Europe does not look great. In fact, there's maybe only one country in Europe that looks good-ish at this point, and that would be France. But almost everything else in the Eurozone is facing this similar structural headwind. So I don't know if we can see the chart there, but when we do pull that one up, you're going to see that Germany, which has been powering most of the EU's, macroeconomic development of late, we have that same V-shaped pattern. And again, once a country enters that V-shaped pattern, they don't tend to come back because you can't turn it around very quickly, right? So that suggests going forward, again, we're looking 10 years plus, that Germany will probably falter in its economic role in the European Union, and France would be relatively better off. But most countries in the European Union are facing this sort of problem. I don't have Italy up there. Italy's is far worse and far more dire. They're about the most dire in the EU. So this is going to be a real difficulty for them, especially when considering how they're going to pay off national debts, et cetera, right? With declining levels of productivity. So
Sebastian, let me ask you this. What are the inputs into these figures here? Population growth. I tend to think of two. It's for fertility rates plus immigration. Obviously, immigration is something that's very much politically on the table right now in Europe as well as in the United States. Are you accounting for that in this balance, or these are just the aggregate roll-up numbers where you don't actually see what the contributors are?
Yeah, these are aggregate numbers. It tends to be that, of course, immigration for especially European countries is not a significant factor, right? In the United States, we have done pretty well. In our case, immigration has offset what would otherwise be negative population growth. So immigration has worked in our favor, but many European countries have far more restrictive immigration laws, and that works against them. Were they to change this, it's a zero-sum game. I don't know if countries generally start doing this, but you're only going to get so many people who can immigrate. I will say globally, the global population is thought to increase over time still, but various nation states that have economic power are not growing at the same rate. India, for example, is doing very well in terms of their demographics. If you look at that, they're the traditional triangle-shaped pattern. If you look at the United States, you'll find that it's okay. I use yours.
I think we get a chart.
Yeah. So the United States there, you are beginning to see a little bit of an inverted V down there at the bottom, but for the most part, it's a triangle pattern. 10 years out from now, we're not going to be facing massive problems as a result of demographic collapse. That will not really affect the United States. And if we do have a little looser immigration laws, then that could help. But in general, the US is in a far better position than Europe. Overall, you would see that the United States is in that kind of more horizontal tunnel type shape, which means that at least for the next decade, if you're going to bet on a market, index investing or something like that, the US is a better bet over the long term than Europe or China. And while a lot of people have made headlines about, a changing global order in which China is going to surpass and replace the United States' global dominance, I tend to find that those theses fail to scale for demographics, right? The only things that could, so in short, this is the baseline concern, and 10 years out, we can be fairly confident that these numbers are going to still hold up. The variable is the impact of technology.
So what's interesting to me about this U.S. chart is, well, two things. At the top, you see that right skew. Obviously, that's because women live longer than men.
Yeah.
But when you get down to the bottom of that chart, it looks pretty good until you hit 20 to 24. And then you start to see that pattern emerging, few people having fewer children. And this looks like, if you just do the trivial arithmetic, a relatively recent phenomenon, a relatively recent challenge here the last 15 years or so in the United States. We seem to have developed that overall pattern that you start to see in Germany. Again, to your point, not coming as quickly, but looking over a longer time horizon, I guess, net of immigration, there you see that challenge.
Yeah, the U.S. is going to face that challenge, and it's worth thinking about. This is where policies that promote childcare would likely help out the United States economy. Those aren't simply policies that would help individuals out, but I could see them as helping grow the economy. So there's a fiscal component behind that. We need to grow everyone's children and help all of the United States continue to maintain its population. If the U.S. can do that, then it will at least have that competitive edge. And I know it's a silly competitive edge, but raw numbers do matter. The other component, though, of course, is technology, which the United States has been a leader in, and we need to continue to innovate. I would say that maybe four main sectors of that probably matter. Again, they're difficult to quantify. Artificial intelligence, for example, tends to have impacts that are not only nonlinear, but they're stepwise. Think about, so if you saw that as a chart, they would look like steps on a chart, right? Think about, wind back to before 2022, nobody was talking about generative AI in 2021. That was just not on the map. And then, we get ChatGPT, it bursts into the public consciousness, and now OpenAI is, whatever it's valued at, I think $87 billion or something like that on its own. In any case, so we get huge changes in a very short span of time. So the difficulty you have when modeling the impact of technologies like these is not only that they're not nonlinear, but they're really stepwise returns.
So let me sum up here just to get to this point. So you're talking about essentially productivity times population growth. We've talked about population growth. We've seen these charts, population growth, function of fertility rate plus immigration. The United States looking on a competitive basis better than some of the other charts that we've looked. There are obviously some challenges down at the bottom as you get lower down that distribution. But to your point, this is something that A, is decades away, and B, is also something that you see vis-a-vis other nations. In other words, it is a relative, not an absolute measure when you look at what's happening for things like index investing. Okay, so this is the interesting part. So we talked about the population growth piece on the one hand. Now we're talking about productivity. This is where it all comes together.
Right? Yeah, and so offsets to productivity decline. We have 1.2 Capital and we have 1.2 Labs. Labs is our research arm where we do a lot of actually just experiments in artificial intelligence. Mostly, we try to figure out how useful is this stuff for anyone. If you try to run a firm with artificial intelligence, you'll find that, well, if you're coding, it's great. It's not really easy to monetize writing sonnets, although ChatGPT is great at that. I don't really know how to do that exactly. A lot of visual art is almost there. It still tends to need the hand of an actual expert. In short, it's not clear how these breakthroughs quite yet translate into solid productivity models, except for sectors like software engineering. And so one of the limitations, of course, is not that artificial intelligence can't figure it out, it's that it doesn't have a body. We could see greater impacts in robotics as a result. Then we could have artificial intelligence helping navigate ordinary tasks, and that's where you could see construction type activities being undertaken by robotics. A third component here might be genetics. The population decline and those assessed relatively, like the levels at which people can still be productive to a society, it sort of turns in part on our medical abilities to fix things in our body. And our approach thus far with longevity is more or less a patchwork approach. We treat the body as if it's a home and you spring a leak and we find a problem and we patch it. That's more or less what we've been doing in that sector. I don't know. I think long-term science for stopping aging is still quite a ways out, but the patchwork approach tends to work pretty well. We'll find some cures with genetic advancements. I don't know. That may have some impacts. Again, it's difficult to tell. Internet of Things, and this begins to relate to maybe some of the impact of digital assets. Real world assets can be, put on a blockchain. Internet of Things sort of tracking lots of small items and having them communicate with each other. That may help increase productivity again, and all of this may interact with artificial intelligence in some way. I don't know. We're looking at those. The final one for me, the fifth area, is of course digital assets, because if you have large swaths of the world population that are getting pushed out of those productive economies, they probably want a way in to have access to financially stable assets. And that is where that asset class seems to be working. My team's summary of things that actually work in cryptocurrencies right now are store of value with Bitcoin, stablecoin payment systems, like that actually works. And gambling. People love gambling on dumb things like meme coins. That's a business and it works. Those things definitively work right now. On the horizon, you have things like real world assets and a bunch of more interesting stuff. But things that work today, those are the things that work right now. So how many of those affect the productivity component of the broader concern? I'm not sure. But it does suggest a way to start thinking about where to place your bets in the world as we move forward, thinking kind of at a macro level, what's going to make sense, what sectors are likely to grow because they're meeting real needs, and why those sectors are likely to grow.
That's just a spectacularly interesting way of framing it, Sebastian, because you start from first principles and then you construct this thesis upward from there. It's really interesting, and it was very interesting. You started out talking about this idea of ChatGPT is good at writing sonnets. It's almost astonishingly good at writing sonnets. When you read it, I think when people look at it, it feels uncanny that a machine can generate output that looks so human. But to your point, in terms of the impact that it's had right now, yeah, it's really good at writing code. You can use it to optimize code and to write code, but where it's actually had an impact on the economy and where it will have an impact on the economy, very much open. I was jotting down some notes. You talked about aging, Internet of Things, robotics, digital assets. Talk about, and we'll come back to digital assets more because I know that you and I have talked about digital assets on Real Vision a great deal. But I'm curious about some of the other points. I mean, you mentioned aging. I thought that one was really interesting because once you get to age 40, you go to a doctor like once a year and they tell you everything's fine, and you say thank God, and then you walk away and you don't think about it again. This is sort of the point of this patchwork view. Is that something that you see changing? Is that something that you see that in the future we're not going to do this kind of patch the leak strategy, but there's going to be a more fundamental systemic approach to slowing down aging?
On that point, my view is that for you and I, Ash, I think we're probably over the horizon of where they could fix us. Damn it. It's exactly that experience. I'm 44, so I have that whole experience of going into the doctor and they don't really try to fix anything anymore. They just tell you to go away. Here are these small problems and you just hope to avoid the main ones. Technologies like homologous gene therapy seem like they're light years away, and that would be the holy grail. But
what is that?
That would be somehow like coming up with a way to splice in genetic, changes to every single cell in your body, right? Which would fix things clearly if we could do that. But that's just way out there. We're still talking sci-fi at this point. I think that for those of us who've reached our age, yes, the patchwork approach is what we have. The good news is that it works pretty okay, and we may get longer lives and maybe more productive lives. Because I think that's the key thing there, is to ensure that people have a higher quality of life towards in those final years. Right, 70s now are thought to be people can be relatively productive there. Nobody thinks that those are bad years necessarily. The general American population clearly thinks that the 80s, that's more or less where the cutoff is. Right, as soon as you hit that range, we start worrying about presidents and whether or not they can, manage things. But 70s is okay, apparently. And that's really the
that's
question.
Great news, since so many of us are going to be paying off our mortgages until we're 92.
Yes, exactly. So That's sort of what's happening with genetics. And I'm not so much looking at age extension so much as, viable years. Things like Ozempic honestly may have more, GLP-1 inhibitors may have more of an impact on the productivity level of Americans, their ability to live longer, not because we're so much raising the bar for the top end of like human lifespans, but because we're making the quality years that we have better quality years. Those are the sorts of things that I think longer term are very interesting. So there we go on that end. Robotics is going to be sort of a double-edged sword. It can help, but we then start worrying about unemployment, right? So we may need some political solutions to make sure the population is able to continue. Right? You want consumers who have money to pay for things, and if you start displacing too many of them with robotics, just to give you a story, my hometown, I grew up in Caldwell, Idaho, which is near Boise, Idaho, which may be the only city that people know in Idaho. Idaho is known for potatoes. And so I grew up in farmland. They decided recently, Micron is near this area, and they decided to build a relatively large 48-acre building. And it has 12 people in it. Just all they employ, because everything else is roboticized. They're building chips, and humans can't really build chips at that level anyway, right? It's more like monitoring and cleaning and security crew, and that's all they have. So in some areas, we've definitely moved towards a robotic solution that humans can't do, and the productivity is very high, but it doesn't necessarily notice it dislocates some of the problems within a nation state. Then you start worrying about unemployment rates, et cetera, like those things. So on the productivity side, though, robotics is a net positive, provided we can do this political stuff. Okay. I don't know. I think maybe we're gambling with the United States on that. Can we fix our problems politically? But, if we can do them all right, then I think that's a net benefit. There are, by the way, sort of direct short-term implications of this analysis. And I don't know if you want to go to that now, but that's where my brain goes is, okay, we've got 10 years out. We kind of know the sectors. We kind of know the areas of the globe that make sense as a, digital asset manager. I do have to act as a sort of a global macro fund manager. And, things that I think long-term, China is out, at least right now. Russia is out. Most of Europe is out for France, except for maybe France. Germany and Italy are especially bad. The United States will be okay. So you start thinking like globally where you want to put your bets, what sectors even matter, right? And which areas could power sectors, right? But then we can switch towards the short term.
Let's go there in just one second, because there's one other question I wanted to ask you about, which is the Internet of Things. And this is an interesting one as well, because this is something that we've been hearing about for decades. It's interesting. It's in some ways, it reminds me of AI. We heard that AI was going to revolutionize the world for decades. I mean, literally decades. And yet it happened. It sort of sprung up in a moment. For those who weren't watching the space, obviously people who were in it saw those developments. But we had decades. If you're over 30, you remember your clock would flash 12 o'clock and nobody could figure out how to set the damn thing. I mean, there was a lot of sort of hype around AI for a long period of time. And then it popped out of nowhere as this major force in the economy, a major force that we're talking about sociologically, culturally, after being sort of rumored and hyped for a really long time. IoT still to me is in that rumor and hype phase. We first heard about it about a decade and a half ago as something that was going to revolutionize every aspect of our lives. So far, no real impact from IoT. What's the status of IoT? What do you see it doing today? And what do you see it doing over the next 3, 5, 10 years?
Yeah, so I do think that IoT is on the cusp of some rather large transformations. I happen to be advising a startup that uses IoT space, so I have really granular knowledge of that at this point. The problem with IoT is they needed to be able to track everything everywhere it moves. That's sort of one of the key things. Say you are Walmart. It would be helpful if you had tags in all of your products, and you could track where they were going, where they got lost, shipping problems, that sort of stuff. And in order to track all of those things, and they're all communicating with each other, then you can get all kinds of really interesting aggregate data, right? About consumer prices, where things tend to go, just the whole distribution chain can be optimized with better IoT effectively. Massive, massive distribution chain impact. This will never be the sort of thing, I think, especially that end that catches the popular hype, but it will dramatically transform any firm that has to ship at volume, right? So where that stands is that you have to have tags that do that. And for a long time, the technology was using RFID tags, which
radio frequency ID.
Radio frequency ID, exactly. And you have to actually sort of manually scan those if you want somebody to do that. So that's never going to work. That's how they track animals in the wild. And it works when a team goes and finds them again and catches the whale or whatever and tracks the tag. But if you want to track billions of products all over the world, it must be passive, not active. You will never scale with that active method. And in order for it to be passive, what you need are tags that interact with something and that probably have nanocomputers on them. So they have these now. This technology is emerging and it exists right now. It allows you to passively track various items. They will interact. The computers have no batteries. They get powered by radio waves, basically. And those power the nanocomputers, and then they can track, location, temperature, like a bunch of stuff that you might want to track, just as the items move around the world. Cell phone coverage problems exist for this. Just as you have a problem always getting a signal with your cell phone, you will have a problem tracking all of these items. That's probably an inevitable feature of this. But we are going to be able to track all of these items, and that will have dramatic impact on various sectors, especially, like I said, for distribution. So when we're talking about increasing productivity, that's what I'm looking at is technologies that can offset the productivity loss. Right? And this is one of those technologies that I think is focused and will be able to offset that productivity loss. And the firms that are developing this technologies they're not publicly traded, but they are the new versions of OpenAI. Right? And so those will definitely be worth investing in, especially as soon as they go public.
Yeah, and this is a challenge of more innovation happening in the private markets, value accumulation taking place in private markets rather than public markets. Sebastian, you've set the stage brilliantly. We understand the thesis. We understand the context. Take it away in terms, back half of this show, talk all about the investment opportunities, investment pitfalls, and how you see the investment landscape being changed by these mega trends that we've talked about thus far.
Yeah. So I think you can tell I sort of track a lot of technology stuff. And that's because it tends to have the sort of impact that could solve these problems. We're looking at technological solutions that could offset productivity losses. That isn't the only thing, though. As the world, so there's a large narrative shift here, and there's some competition among fund managers to give a nice narrative of what's going to happen over the next 10 years. Some people think that most people agree there's going to be a change in the world order, but in the world order being sort of the Bretton Woods version of the world that we know. I don't think it's going to turn into one sovereign nation going to another. Rather, it's going to turn into this, and most people I think agree, sort of smaller, more fractionalized world. And that means that very specific technologies will have an impact in certain areas. So investing in US technology matters, for example. The difficulty is that those sectors are bubbly, which is why I have a whole course on the art of the bubble. Right? Because if you're looking at things this way, then you're looking at technological growth, and you should probably think of, say, the dot-com boom. People were right that the internet would revolutionize everything. They were wrong that it was going to happen by 2001. An inherent feature of the technologies that will have an impact for us is that human minds are stuck with what I would call a linearity bias. People probably know about an anchoring bias. I think it was Dan Ariely, a behavioral economist. At least he reported on an experiment that he ran, or some professor ran with their students. They had them all come up to the front of the room and bid on a nice bottle of wine, like how much they would pay for that nice bottle of wine. And people who, before they did that, they had people write down the last two digits of their social security number. So you could get numbers between 0 and 99. People who had lower numbers like 18 tended to bid somewhere in that range. the $20 range. People who had high numbers like 9.7 tended to bid in the 90s. Their brains, for totally irrational reasons, were anchored to those numbers. Right? That shouldn't have affected what they bid for the bottle of wine, but it did. Okay, something similar happens when you think about emerging technologies. We tend to think of them as growing in a linear fashion, but they don't. They grow in nonlinear fashions. And the result of that is that people overestimate the near-term impact of these technologies and underestimate the long-term impact of the technologies. So when you, that's just a recipe in short for bubbles. You're going to have bubbles with technologies. People are going to get way too interested in them at the beginning and then lose a lot of interest when they should be interested in them and then kind of try to catch up late, right? That's sort of the basis for bubble trading. And at least until AI does all of our trades, I see us as stuck with these kinds of dynamics, people getting really hyped up about things and then losing interest right when they begin to matter. So, I mean, we already discussed that, for example, with IoT. I think IoT is just about to make a breakthrough, but hardly anyone's talking about it. So with that in mind, that's where I begin to look at some of these technologies and the transformations they might have. One of them, for example, is in the sort of the EV market, green tech, especially electric vehicles. That is an interesting one because it faces some sort of supply chain constraints. One of the things that Tesla did in a couple of ways. One of them is just getting enough lithium for the batteries, but another one is, being able to charge our cars. So it's not as if the technology itself is a problem, but the infrastructure there is a problem, right? So people are then, again, really happy about the tech. It meets reality. You need to change a bunch of infrastructure. We're going to have several years of infrastructure overhaul before that market becomes completely usable in the way that people want it to be usable. That's just an example of like the three phases of hype, disillusionment, and then catching back up again in the third phase. Roughly, that is the pattern that I see unfolding in all of these sectors. I can get to specifics if you want, but yeah, we can talk specifics, but that's kind of like the general pattern.
My first question is, how do you find the scale on the x-axis, right? So this is, if we think about our lifetimes, guys, about our age, Sebastian, you go back to the dot-com implosion around the year 2000. It was brutal. It was painful. The thesis was correct. The time horizon was wrong. How do you begin to estimate what a time horizon looks like? And how do you psychologically prepare yourself? I mean, we've talked about Daniel Kahneman, Daniel Ariely, all these great behavioral economists. The challenge is how we perceive the world relative to some of the underlying facts about the world. How do you begin to think about that?
Right. I don't. Right. Right. Like just so there's two interesting components here, right? One of them is so a key feature then of all of these innovations is that they're cyclical. And I just stop trying to guess exactly when that's going to happen. That is where I write algorithms to kind of just track things. People can track things. They can proxy them pretty all right. Honestly, for these technologies, they can track them all right with just standard momentum metrics over various sectors. It's going to tell you when they're declining and emerging. It's surprising that something like this complex can be resolved that easily. But what you're facing is two key features, right? One of them is that these sectors have a fundamental technology, and another is that they have, a psychological premium built in. Right. And measuring the psychological premium is something you can do up to a point, right? Sort of well, have a bot, crawl Twitter, look at hashtags, whatever, do something like that. But it's really difficult. And so the key thing to keep in mind is that the bubbles that happen, and we're going to continue to see these, are slow to decline. The dot-com bubble gave you, it declined over almost 3 years. So you could be quarters late exiting the dot-com bubble and still have been okay, provided you started getting in early on in 95, right? It's really about being aware of what these sectors are and cataloging them, almost just having a better memory than other people about the things that people used to talk about. And then just following them forward will give you a better approach to them. You
So when
could,
you say I don't, what you're saying is it's uh, almost impossible to track on a fundamental basis
yeah,
where you see these inflection points in terms of pricing. But surprisingly, on a technical basis, you can actually follow momentum and sentiment indicators, which will give you a sense of the cyclicality of that investment, which has, it seems, almost a surprising degree of signal in it.
right. Yeah, I mean, the only fundamental basis that you can use is, I mean, we track liquidity flows quite a bit.
Mm.
Um, and so we get granular about that with, cryptocurrencies, for example, is making sure that, or digital assets, making sure that there is enough free liquidity in the market. And then, I mean, that's like a reservoir. You want to make sure that you're watering your crops, right? So the actual flows are the watering of your crops. Um, you can look at that by, US dollars into various exchanges or things like that, and look at those measures to really track that capital is moving into the space. So if you wanted a fundamental basis, like that would be the way to look at it, because these technologies are emerging. They'll always be considered growth technologies, and hence they will be further out on the risk curve, right? They're not going to be on the conservative side. They're going to be on the growth side of the risk curve. And that means that if you wanted to look at anything fundamental for them, yes, liquidity flows overwhelmingly. That's where you go. But beyond that, you have to look at, well, okay, that's still not granular enough. So that's when you can look at, yes, technical metrics matter. You can throw a lot at it. You can make it more or less sophisticated. I run a whole ML algo over this, but yeah, honestly, technical metrics can matter for just assessing when sentiment is finally changing, because ultimately the thing that moves capital into this space is hope in new technology. So Kathy Wood, by the way, has the opposite approach. She picks her sectors, waits for them to capitulate, and then buys a lot, right? And so her view is a very long-term view. That's kind of what's running ARK Investments, is that these technologies will transform the world, and we're just going to buy every capitulation event, a large dump in some price in a company that we think has promise. That's her approach. I just find that you're going to get a lot of volatility with that, and it's better, right? Because the prices move up so much given sentiment that it's better to just not try to do that. Buying and holding these things is a recipe for, some, I don't know, more stress than I would like to bear. And I'm the guy who manages a crypto fund, so. Yeah.
I guess it's nice work if you can stay solvent that long.
Right. I will say there's that too. Right. Yeah. If you can drop 60%, and then everyone still loves you, then fine. But yeah, I do find a lot of overlap with what they're doing there at ARK Investments. I do think that they have a lot of the key sectors down. Again, it's the timing though. The timing will ruin you if you do this wrong. There are other areas that matter, though, that are just broadly cyclical, that follow from that global analysis. Look, if we're going to be re-regionalizing, then you have to worry about how we're going to be getting the stuff that we're getting. A lot of the commodity-based trades are themselves pretty straightforward. Oil is going to be a problem. The United States patrols most of the U.S. waters still. If we didn't do that, sort of global oil supply would be disrupted. That's a relatively inelastic market. Small changes in global, oil demand sort of create dramatic price changes, and so you can watch those areas too. I do find that as our world changes over the next 10 years, the key thing that we're going to want to watch are sort of commodity cramps. We're going to find, and that will result in pretty immediate price spikes. And by pretty immediate, I mean 1 quarter. Right? Again, we're not talking like day trading here. We're talking like 1 quarter price spikes that go up as a result of supply crunches that are just going to be part of our just investing lives going forward. And some of that stuff can be really easy to trade. Oil prices go up. You know what happens? Oil stocks go up. The price of lithium goes up. Most lithium companies make money. This stuff is not terribly difficult to track.
Yeah, it's interesting, and I know something else that you track, as you pointed out earlier, was this idea of liquidity flows, which, in a certain sense, and we can do this very easily. I mean, if you look at Bitcoin and you look at the responsiveness to, for example, rate cuts here in the United States, you almost see this place where fundamentals meet technicals.
Right. Yeah, and that's why we do think that. So looking at global liquidity, I don't know, a bunch of people have done this. Even in crypto Twitter, people are doing this. So regular people are now mapping global liquidity flows to various cryptocurrencies and just putting it out there for everyone to see. The correlations are pretty solid. And that's what you would expect. Of course, it's not just, again, that's water in a reservoir. If you want to make specific bets on Bitcoin or whatever other coins are out there, you do have to, kind of be a bit more granular about that. But in general, that is not hard to track. You can search most of it, and the interesting implication is that probably there's this thesis that cryptocurrencies operate by a halving cycle. That Bitcoin's supply constraints are what have historically caused price increases. But it turns out that a closer correlation is between Bitcoin prices and global liquidity. If you map that over the various cycles, people tend to see that it was just sort of coincidence. You get a Bitcoin halving. That's when the issuance of Bitcoin is dropped by half. And that happens every 4 years. But it looks like that was just a coincidence. So you got a huge spike in 2012, 2016, 2020. There's an expected spike in 2024, et cetera. But that more closely looks like it. If you break down month by month, actions that follow liquidity, global liquidity, and especially the United States liquidity, because the United States is still the largest market, tend to be more directly related to that. And that means that just over September, if you had been waiting for the Fed's expected cut and just bought before the 18th and held some Bitcoin, and then after the 18th, it went up a whole lot. Some of these bets almost look foolishly simple, but the correlations are there to support that kind of analysis, and they're relatively robust. And the reasons behind the correlations make sense too. Risk on market, you need more capital. Yes, there may be a recession longer term. Typically, as soon as the Fed starts cutting interest rates, we're looking at a recession somewhere in the range of 6 to 18 months out, typically. But if you are trading cryptocurrencies, 6 months is, cryptocurrency market, that's forever, right? So there's plenty of time to make money before the recession hits. That's how I look at the merge between sort of the fundamentals that we have and a lot of these technical points that are otherwise require you to analyze, use new tools, new analytical tools.
It's funny when you talk about the Bitcoin halving cycle versus liquidity flows. I've often wondered this myself, which is it's kind of like, well, is it a surprise that the block reward is getting cut in half? Like, right? I mean, you literally, I know when you look at the chart, you can see it pretty clearly, but it does sort of beget the question, why does that happen if it's known literally mechanistically in the code that's going to happen, and yet you still see the price fluctuation. So it's interesting to try and tease that out versus liquidity cycle. Let me ask you this, by the way, 45 minutes or so into this conversation, it makes perfect sense within your thesis. When you said at the beginning of the show, you can see the long term, you can see the short term, things break down a little bit in the middle in terms of what the path to getting there is. Let's talk about the short term. Talk about what you're seeing right now. Talk about where you're seeing opportunity. Talk about where you're seeing an unbalanced view of risk. Talk about what you see right now relative to all of your indicators.
Yeah. So right now, what I'm looking at is, another source of data that we really like to monitor are what we call gambling markets. And by which I mean not actual gamblers, although sometimes that, but betting markets on Polymarket or something like that, but where somebody is incentivized to place a bet on the direction of something. So if you track credit spreads, for example, between, say, the average 30-year interest rate on home mortgages and the 10-year U.S. Treasury, you'll find that spreads there effectively, if it's spreading, the difference between those is spreading, bankers are expecting fewer people to pay back their loans, right, relative to the treasuries. If it's collapsing, they're making a bet that more people will be able to pay back their loans. That's what we mean by a betting market. Incidentally, some of that data has been really strange for real estate. Not that I do anything in real estate, but we've been watching it just because you would expect that with an interest rate cut that margin would collapse, and in fact, it has widened. which indicates that at least bankers in the real estate market think that there is trouble 18 months out or something like that. So these are questions, are we going to, one of the key questions I think that our team has been discussing is not, are we going to have a recession? There's always a recession. And I think that you see headlines that are clickbaity that say, one is coming. The answer is yes, one is coming. When? When is one coming? Because that makes all the difference. And typically after an interest rate cut, you're not going to see it for a bit. Very short-term betting markets on US S&P 500 are less than optimistic through the election right now. I think there's a lot of uncertainty is what those markets are suggesting. If you track the ratio of calls and puts on the US S&P 500, they don't know. That's actually, I find that interesting. A lot of the market has been going up in expectation of the interest rate cuts, but people who are hedging their bets are uncertain, which is okay. That's sort of surprising. In short, they may think that we've reached a local top. I don't know, but that's what that data suggests. Cryptocurrencies, no, those have responded very well to the Chinese market cuts, almost more than the US interest rate cuts, because I think the US interest rate cuts were more or less priced in. And if we're looking at Bitcoin longer term, we have to see probably the key question for all of this is unemployment, right? We're no longer looking at interest rates. We're looking at the other side of the Fed mandate, because if unemployment begins to move too far above that stated 4.5% unemployment, they don't really want it to go over that, then we will see not only more aggressive cuts, but there's a concern that at that point we are tilting into a recession, right? And so at this point in the US, that is the key number. And there's an interesting kind of fiat in the sense of will. The Fed has just decided to will that 4.5% is this sort of thing that they don't want unemployment rate to exceed. That's the key variable there. Thus far, we're okay. Inflation is coming down. Jobless claims are surprisingly pretty good thus far. So, it is an uncertain market, but uncertain markets tend to be transitional. And that means that you can get in a little early on them. So I would be, in cryptocurrencies, everyone there expects October to be great because it has historically been great. I think it will only be great if we continue to see interest rate cuts without a large uptick in unemployment or an uptick beyond 4.5%. As far as the broader macroeconomy goes, if you were index investing or something like that, well, it's okay. That's what traders people who take bets, they seem to think it's okay. They're not overly negative, but they're not overly positive. So I think there's just a lot of concern about what various administrations might mean for the U.S. economy, and that does show up in the data that we look at. It's not that they think Trump or Kamala is better. It's that the two presidencies offer very different views as to which sectors will do better when somebody's in power.
Yeah. So, inflation obviously ties very closely in with rate cuts. You talk about it. We're almost living in this weird Schrodinger's cat-like environment with this presidential election. It's interesting. You mentioned the short-term S&P futures. Markets hate uncertainty. We know that even when there are negative events, when they get priced in, when markets can get a handle on them, they seem to price it more favorably. Is there any signal that you're getting from this polling data? I look at the polling data every day. I go to Real Clear Politics.
Oh yeah.
I look at their state-by-state polls. I see nothing other than I just throw a coin in the air. I see no indication from the data where this is going to land.
That data for us is sort of difficult to assess. And the large overhang with that is we do not know how accurate the polls are. Everyone in that community got burned, right, in 2016, and there's hesitancy to accept that the polling data is as good.
And by burned, you mean essentially they underreported or underpolled Trump voters. And I guess the question now is that happening again, or have they overcompensated in the opposite direction to try and correct for the mistake that they made in 2016?
Right. They're certainly more cautious, right? And I think if you talk to the pollsters there, they claim that they've accounted for those things. people who specialize in this, Nate Silver and whatnot, are far more confident in these polls than they were back then. But then again, he was confident in the 2016 polls too, and he got it wrong. So, my sense is largely to ignore that noise and say that we're close enough that who knows who could win. And that's where I like betting markets. Unfortunately, Polymarket does tend to have a skew towards Trump. It's a cryptocurrency-based market. Cryptocurrencies tend to skew towards Trump. As far as we can tell, about 2-3% skew towards Trump on Polymarket as far as those bets go. And that means that while it typically has Trump winning, it's probably a statistical tie. That, again, betting markets, when people put their money on the line, I just find that that's better. Far better, and you can aggregate, because when you're relying on polls, you're relying on specialists, but it's helpful to have the wisdom of people. A lot of these things aren't so much difficult problems to comprehend. It's that we can't source the information from the right places. And that's why crowds are better at sourcing the information. You don't need a guy with 180 IQ to figure this thing out. The math is relatively straightforward to aggregate and do your stats. You just need a regular person to do your stats. What you need is better information, and that is better sourced through crowds rather than specialists. And I think that that's my preference for this sort of data. I will say that as far as options markets are concerned, they see that the market is going to do better after the election. At least that's the pricing right now. In short, there's just uncertainty through the election. Afterwards, the market will figure out, yay, cannabis is either going to happen under Kamala Harris or not. Right? It's this sort of a binary bet. If you want to buy CGC right now, a canopy growth company, and Kamala Harris is elected, then cannabis will be legalized. She wants to legalize it in the United States. Some real proactive steps are going to be taken, and that stock will probably shoot off 30-40% in the next day. Otherwise, it'll crater. Right? So some of these, I tend to think of that as just a fulcrum point, because that market is, and it's an interesting case of an emerging market. It's not like technologies where people overestimate the impact of technologies immediately. This is a legal thing. So it's really just a sort of a binary outcome, as opposed to who is going to write the legislation that allows this market to flourish and who isn't. Cryptocurrencies aren't quite in that space. Trump is probably better, but Kamala Harris is at least listening to Mark Cuban, and at least he's doing his job to make sure that the Democrats will have some impact on cryptocurrencies that gives more regulatory clarity, and then that market comes back. So probably in both cases, that's going to do all right. But key features, so green energy, that's an interesting space. I don't know how a lot of Republican states actually benefited from Biden's policies, even though they don't like the Democratic policies. I do tend to think that those will, when push comes to shove, still look for the support that they've been getting. The real outlier there is cannabis. And that one goes well with Kamala. I don't think that oil necessarily goes well under Trump, even though he's in favor of the industry. That largely turns on global sort of supply dynamics, not presidencies.
Very interesting. We've got a question from JP, and it's a really interesting one. I want to get to it before we wrap here. The question is, you mentioned a potential recession within 6 to 18 months. How does this reconcile with the leading indicators for the ISM, which indicate we're coming out of a trough in the business cycle rather than declining from a top?
Right. Now, I've been looking at those too. And again, that's consistent with, pretty good. That's consistent with the argument that says, look, these worries about a recession are overblown. I think that a recession 18 months out from now is just always a probability. And if we're talking about that's not even worth addressing. Of course that could happen. 18 months out is far, anything beyond 12 months out is far enough beyond our ability to assess with a lot of clarity. So of course it could happen. Meh. The real question is, will it happen before 12 months? And that's when the expected normalization of the federal interest rate cut cycle probably ends. I don't know. You can look at the Fed Watch tool and have a sense of that. The ISM data is positive, right? Jobless claims positive, unemployment rate not too bad. Core PCE came in really well. For the most part, the economy looks like it's doing all right. And there is a legitimate chance that we get a soft landing, in which case, okay. The only thing that I find that's sort of against that in the near term, like I said, is the uncertainty that I see in the options market over the S&P 500. And that's uncertainty, not negative. It's just uncertainty. And I attribute that to the political election cycle. So completely consistent with the bullish case. And to be fair, I am in the bullish camp. I don't think that we will, at this point, I don't think we're going to see a recession in the next 12 months. We might in the next 18 months, but that's always a possibility.
Right. Sebastian, great conversation here today. I knew we ran long, but I just wanted to get this conversation to the fullest out there to people. Before we wrap, I should say, of course, I mentioned at the beginning of the show that you have a Crypto Academy course called The Art of the Bubble, which you can find on the Real Vision website in the Academy at realvision.com/Crypto Academy. Again, that's realvision.com/Crypto Academy. But I wanted to give you an opportunity here to talk a little bit about that course, why you created it, and what people will learn from it.
Yeah, it comes pretty directly from the discussion, as I've said. So I'm looking at emerging technologies that will have an impact in solving kind of what I foresee as the next decade's problem about sort of global growth. And those technologies are bubbly. It's both. The interesting thing about bubbles is that a lot of people say you want to run away from them. I find that if you learn how to manage a bubble, they're the greatest wealth builders you can ever put your hands on. That's how I went from being a professor to being a fund manager, is by trading bubbles. So the only difficulty with bubbles is that they are counterintuitive. Like I said, the linearity bias is one of those. There are many biases that humans have that go into bubbles. And the purpose of that course was to lay out a set of lessons. I make about 25 lessons that sort of keep you in line with how to trade bubbles, knowing that a great deal of what you're trading is sentiment based. There's always a fundamental basis, but there's that sentiment premium there. So you got to learn to manage that and what that means. So you're going to have to address, the features of human behavior that are a bit irrational, but fortunately are pretty predictable. So that's what that course does, 25 lessons and how to manage the counterintuitive effects of bubbles. And if you can do that, I think that you have the opportunity to transform your sort of financial status relatively quickly, much faster than almost any other opportunity out there.
Well, what a great place to end this conversation, since it arises organically through the conversations we've had here for the last hour or so. Really a terrific conversation. Sebastian, we're going to do this more often. This is
we should.
Great conversation.
Yeah.
I mean, I'd love to watch you host, man, but I'd love to get you on to do this conversation more often.
Yeah, I'd love it. This was a lot of fun. Thanks, Ash.
Sebastian Purcell, thanks for joining us. Thanks for watching. Thanks for listening. Another great conversation right here on Real Vision. Have a great afternoon, everybody.
What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.